All that fintech magic depends on one thing: India's domestic economic health. And there's good news on that front. Two important economic indicators are looking solid: inflation and industrial production. As central bankers would say, let's deal with inflation first. India's consumer price index fell to 4.25% in May, and that's a 25-month low. Inflation was around 7% in May last year. Now it's 4.25%. Now the Reserve Bank of India has a tolerance band for inflation, sort of like a preferred range. And the upper limit here is 6%, which means at 4.25, India's current inflation is well within that range, well below that 6% upper limit. Now look at other emerging markets. In Argentina, inflation is almost 98%. In Turkey, 50%. Iran, 42%. Egypt, 21%. These countries are reeling under higher inflation. What about the developed world? The cost of living is already high in these countries, and inflation figures are a mixed bag. The numbers have cooled off in some countries like Canada, the US, France, and Italy, but others are not out of the woods, like the United Kingdom. Their retail inflation in the UK is 6.8%. In Germany, it's 6.2%. And this has a direct impact on economic output and health. But more on that later. For now, let's look at the second indicator, factory output. It is measured using something called IIP, Index of Industrial Production, IIP. It had fallen to 1.1% in March this year, but in April, it rebounded. The latest number is 4.2%. And this represents a notable increase for India. If you rewind to late last year, factory output was in the dumps. It was negative 4% in October 2022, meaning the output shrank. So the latest data shows a positive trajectory. And how is the rest of the world faring? China's industrial output was up 5.6% in April. But there's a catch. The market expectation was much higher for China, more than 10% in fact. So the pace of China's industrial recovery has been slower than expected. Could that be an opportunity for India? It could, but a lot depends on the RBI. That's India's central bank. For booming growth, you need to cut interest rates. You need to make loans cheaper. But is the RBI ready for that? Most experts say it's not. I mentioned that 6% inflation is the upper tolerance limit. Right now, it's well under that, 4.25%. But the RBI will look for a sustained dip, perhaps below 4%. It will also look for clues from the US Federal Reserve, that's America's central bank, the US Fed. It is still hiking interest rates. Once the Americans stop, other banks are expected to follow. So India, you could say, is on the starting line, ready to begin the sprint. It's all about waiting for the buzzer. But some of the other sprinters are nowhere in the picture. In fact, they may not even turn up. Take a look at this map. It shows three sets of countries: those already in recession, those at risk of recession, and those expected to escape. Germany is already in recession. They've had 2 quarters of negative GDP growth, which is technically recession. Next in line could be the United Kingdom, the UK. They have a 75% chance of recession this year. New Zealand has 70%, the US 65%, Australia 50%, and Canada 60%. What about India? As things stand, there is a 0% chance of recession in India. Saudi Arabia too is doing well, just 5% chance. China is at 12%, Brazil at 15%. So the big takeaway is this: the developed world is not out of the woods, but India appears to be safe. How did that happen? How did India buck the global trend? Well, you can't point at one specific reason for that. It's a combination of many policy choices, really. We look at 3 of them. For starters, cheap crude from Russia. That has really worked. By not taking sides in the war, New Delhi got good deals. And that's one reason why inflation is under control. The second reason is related to the pandemic. Do you remember what most governments did during the pandemic? They announced stimulus packages, and most of them were cash transfers. The US, for instance, spent about $250 billion on it. American citizens got checks up to $1,200. I'm sure it helped them, but there's a downside to such policies. More cash supply leads to more inflation. It's economics 101. But India tried another route. Things like free food distribution, loan concessions, more investment in pandemic-hit sectors. Perhaps that cashless approach worked for India. Because the biggest problem for developed economies is inflation. They've controlled it with interest hikes. But what happens if they pause? For all we know, it could shoot right back up. And that's where India is better placed. The RBI paused interest hikes back in April, yet inflation is sliding every month. What happens next is mostly out of India's hand. One is, of course, the global economy. The other is monsoons and El Nino. That's the third thing that has worked in India's favor so far, some good old luck.